Hello, hi, welcome to my channel. How are you? Everything's good. Okay, today's topic is IAS 12 income tax. Okay, because many students asked me to make a video on it, so I just got free, so I thought to make a video. Okay, just a quick one today. I will take a lot of your time, so I'm gonna be very fast. So if you feel like I'm going fast, so it is best if you pause my video and do practice, because today I want to complete all IS 12 in one lecture. I will complete all in one lecture, and plus we have to practice more questions, so you got to be very fast. Okay, let's not waste time. Okay, the thing is, I mean, in my lectures, when I make it on an Apple iPad, and I using my Apple Pencil. So all my lectures are in one go, or in like one go. There is no editing, so I don't pause and edit. I don't trim. I don't cut videos. I don't delete it. So whatever you see is in just one go. Okay, so let's start. Thing is, tax. Companies pays this year tax in the next year. If we are if we are in 2015, and if we are in 2020, we will pay our tax in 2021. Okay, that's why it says, I'll show you. Just make a timeline. Today we start this year, December x6. For this whole year we will earn income here, and we will pay tax for this year. In next year, in x7, we will pay x7. Suppose December x7 we will pay tax, and suppose we have to pay around let's say we pay. Before this, I will explain you what is under and over provision. So because this year we will pay tax the next year, so we make an assumption that maybe by next year we will have to pay 100 as a tax. In next year, we suppose by next year we realize it that instead of 100 we have to pay just 80. So it means we over provision. It was a over provision. We made over provision, so we can might deduct it. And if it is under provision case, like if it is under provision, so this is expense. This will be the under provision will be our expense. It means instead of provision was, if we say a provision was 100, but in the next year we realized it, we paid instead of 120 we paid, so instead it means we paid 20 more. So it was underpaid, under provision, under tax provision. So that's tax expense, because we have to incur expense. This is the main scenario. This is the main thing. So whatever profit and loss, how will we make profit and loss? So current year tax. So suppose if we say this year we have to pay around, say 100, we pay 100 this year, and then we say in the previous year there was a less provision, the provision was less, so then we add under provision because it was less provision last year, so we will add in this. So suppose it was less provision of 20, then in this year we have to pay tax 120. So this is the main scenario. This is how it works. Okay, why there is a difference? Why we need to keep these things? Why we need to keep it's a why what is the need? Why IAS 12 came in? What was the point? So I tell you. So remember in my lecture, if I am for the same amount of period, if you're in booking an income, then you have to book a expense which is cost of sale for the same period. It is a matching concept. And I will tell you one more thing. in accounting we work on accrual basis. In accounting we work on accrual basis, but tax department they work on cash basis or receipt base. I will tell you everything one by one, but I have to very fast today, so please, if you feel like I'm going fast, pause my video and go back again, listen it again. So the thing is, how we make profit and loss. Profit and loss, we make sales. Suppose we make sales on, if we are making sales, if we are making a profit and loss for December x6, then we need to take cost of sale as well for the same period of time. Cost of sale for the same period of time, it is a matching concept. Okay, then you get gross profit. And in this year, if you heard a company announced that we will give dividend, and you heard that you're gonna get the dividend. Wow. So in this way you will say dividend income. So if company A says will issue dividend, and you are making a profit, and for the year end for suppose for company B, and this is a company B profit and loss, you will book a dividend because you heard this is a receivable. So what you gonna do? So what you the moment you heard this, you will say you will debit receivable because you know you're gonna get it, and you're gonna get debit receivables, and you're gonna get profit and loss. That means you're gonna get this income. And what you did, you went if you suppose you have GP of 300,000, this is your gross profit, and you heard that you're gonna get 100,000 as dividend income. You got 400,000 here. This is your PBIT. I'm ignoring interest in it. Then you got your profit before tax. Then you said, okay, let's pay tax. You being nice guy, you went to the tax department. You said, this is my income 400,000, and this is I want to pay tax. And suppose the tax rate is 20%. Suppose, and income tax department open the your profit and loss. He said, okay, what is this? Sales. Okay, what is this? Cost of sales. Fine. What is this? They will ask, what is this? You said, this is the dividend, and by next year I will receive my dividend. Then tax department would say, have you not received it yet? Have you received it? I would say no. I will going to receive it by next year, not now. So but I wanted to pay tax. He would say, no, this is not working, mate. We are not, because it's assumption is just unrealized income, it's not being realized it. So tax department would say, we work on cash basis, not the accrual basis. So once we will not pay tax, we will not take tax. I was very happy. I said, no, wow, I save tax. But they said, not now. When you're gonna receive it tomorrow, by next year, then I will take my tax on it. I will charge tax on it. I would say, okay, in either case I will have to pay tax, but not now. Maybe when I will receive it, I will pay tax. What I did in this way, I would say, I will calculate here. I need some space. Okay, what I would say, because as per my profit was 400,000, right? This was my profit. But as per tax department, as per tax department, they said we don't we will not take we will not charge you tax on this income because this year you have not received it yet. So minus less dividend because you have not received it. So minus 100,000. So as per tax department, it is 300,000 profit, taxable profit, taxable profit. And if it is 20% tax, take a 20% on this. So it means tax is 90,000 tax. This is the current tax. It means this is the tax I will have to pay this year. Current tax. Current tax will pay in the next year. Okay. The thing is, you will see the difference. Here my tax profit is this, but here my the tax as per my profit and loss statement, my tax is showing, my profit and loss is showing 400,000. For the tax department, in tax department I, the profit is 300,000. What I have done here, as per me, it is sorry, just wait. Just take 30% instead. I just make it easy. Just take 30% of it. 30% of it because in my notes it's 30%. Okay. If you have tax rate of 30%, if I would charge 30% on this, I would pay 120,000 as tax. And here I would have paid 90,000 as per 30,000. So you can see the tax difference. As per accounting department, tax is showing 90,000, but as per my books it's showing 120,000. It is just the time difference because not today but tomorrow I will have to pay. When I create a receivable, what I did, dividend receivable, I showed you the entry before, receivable. So I said I will receive 100,000 receivable by next month, next year. Profit and loss 100,000. This is what I will do. But accounting tax per world will not accept this. So the thing is, not today but tomorrow I will have to pay tax on this. How much I have to pay tax? As you can see, how much I have to pay, 90 and plus 20. How much is the difference? 120,000 minus 90,000. It means 30,000 is the difference. It means 30,000 is the amount which you will pay, not today but tomorrow. As per my records, it was showing 120,000. Out of 120,000, 90,000 is for this year, and 30,000 when I will receive the dividend, I will receive it. So it means if I receive it tomorrow, I will have to pay this amount. I will have to pay my tax. It's a liability. So what I did, it's a profit and loss. So if you are taking your income in profit and loss, then you need to book this. If you're booking an income to profit and loss, then you have to book a cost of sale against the same income to profit and loss. So I will take profit and loss due deferred tax liability. It means it is being deferred. It is not being cancelled, but it is being deferred by next year. So what is the deferred amount? 30,000. 30,000 is the amount which you will pay next month, next year. So this is the main hint, this is the main point. If you are booking, if I'll just write book revenue, then book cost of sale, cost of sale. Otherwise it will not be a matching concept. If you want to be a matching concept, you have to pay this thing. this was the definition of receivable. When you have to pay, because you're receiving amount today, dividend, but you're gonna receive the amount next year. But if you're going to receive an amount, then you will have to pay tax on that amount. Now the case is, now the second case is, instead of income, we will say that we have to pay some expense. You get my point? If you are going to receive income, then book your tax, because you're going to receive income, then you have to pay tax on that future income. So it's your liability. But this time around, if you think that after 1 year you have to pay this amount, like say next year you have a warranty claim of 100,000, so it means not today but tomorrow you have to pay. So let's do an example. I will tell you the story. Sales, then cost of sale. Please book cost of sales on the same period. Suppose you have gross profit of 300,000, same GP. Okay, I'm ignoring interest. So what I do it is, so we have a claim, like we have a mobile claim, suppose, less warranty claim. Warranty, how much? 100,000. And we will say 200,000 is our profit, PBT. Okay, I go to the tax department again. I said, this is my profit and loss, this is my profit, I want to pay tax. How can I do it? They said, okay, let me see your profit and loss. They said, okay, this one is nice, this looks good. Cost of sale, you minus it, is good. Gross profit looks fine. He said, what is this? I said, this is my liability. Tomorrow, next year, I will have loss, or I will have a warranty expense. He said, no, we are not accepting it, because as per accounting purposes, as per IAS 37, warranties is a present obligation from the past event. Okay, you have to meet all these criteria, measured reliably. Okay, and the probable chances of being probable. Okay, everything is fine. Then it met IAS 37 criteria. Then you, what you did, as per accounting, profit and loss debit, and you credit provision for warranty. That it means you have to give warranty next year, 100,000. Okay, but what this tax department did, let's do the tax department working. When I go to tax department, they said, they said this is because they work on cash basis. It says, have you paid this warranty? I said, no, I will pay in the next year. I said, okay, if you have not been paid yet, if you did not pay your warranty, then you cannot claim that. You cannot claim tax. So because when you will do the expense, then we will allow you the expense, then we will allow you the tax expense, but not now. So what he did, the tax department, they will add it back. So gross profit was 300,000. That was my gross profit. And then they said, no, you have to add this warranty back. How much? 100,000. They said, add back the 30,000 and plus 4,000. Oh, okay, 200,000 is pro PBT. Let me see, it's not gross profit, it is PBT. They said, no, you cannot take, you cannot avoid, wait, let me add it back. Okay, they will say, no, you cannot revert it back, because you will pay this in the next year, then you will allow it, but not now. So you can see, if the rate is same 30%, if as per my accounting, tax would be 20%, which is 60,000. Okay, and as per as per their taxable liability tax department, tax is 30. If you take a 30% of 30,000, 300,000, you will have 300,000, 30, 30 and 60, 90, 90,000. Okay, by tax department they will have in their books they will have 90,000, but in my book it will have a 60,000. Okay, and then what you did is profit and loss 100,000. It means you book your expense to provision for warranty 100,000. This is what you did before. So you booked your expense, then you need to book your revenue with it. The tax relief is your revenue in this way. So deferred tax asset, because this is your asset, because you instead of 60,000 you just need to pay 90,000. So it means 30,000 is tax saved. So you can see 30,000 is your revenue and is your asset receivable to profit and loss. You can take profit and loss here because you are taking here as profit and loss, and you need to here debit. If you can see, I am booking expense on the same time I'm booking their revenue. So two matching concept is a matching concept. Okay, why is the difference between these two? Why is the difference? Same goes for government grant. What in this case? Suppose same sales, cost of sales, you book a revenue, you get GP of 100,000, 300,000, same thing, GP. Okay, what you did, government announced you that if you hire 30 people they will give you 100,000 government grant. Or I will tell you, during this coronavirus things, UK government announces a furlough scheme, government grant. I'll just write furlough scheme. It's a government grant to secure the job retention, furlough. Okay, what UK government did due to this pandemic since March, because many people lost the job, then the government announces do not laid off people, do not terminate them. Government will pay 80% of their salaries. So like whoever is earning 100,000, suppose he will get 80,000 from government, not the company. So what they did, company pays this 80,000 to the Mr. A, and company claim back 80,000 from UK government as government grant or furlough scheme as furlough. Okay, if you receive a government grant, suppose you receive 100,000, you get 400,000 as your profit before tax. I go to the tax department, I said this is my profit and loss statement. They said okay, this is fine. Cost of sales, you book your revenue and you book your expense, fine. Gross profit is fine. What is this? I said this is government grant, this is furlough claim. I received the government grant from government. He said okay, we are so kind that we do not take tax on the government grants. It's tax free amount. I said oh okay, nice, I don't need to pay tax on it. So in this way how we will trade? As per accounting profit, tax plan we would do, profit before tax was 400,000. This they would minus government grant because it's tax free. They would say there is no tax on it, so government minus, it means you just have to pay 30% on this amount, on this only as a taxable profit. which is just 90,000. If we just need to pay 90,000 on this, you will have 310,000. So this is how it works. Because I will tell you why I did not take it out. I'll tell you now. There are two differences. There are two why the deferred tax arises. Different timings. Why we need to have the deferred tax. Deferred tax means you will not need to pay tax today, but maybe tomorrow you will have to pay tax. This is your story. Today you don't need to pay tax, but maybe next year you will pay tax. It means it was being just deferred for 1 year. It was just being held for 1 year. So there are two differences. One is temporary and one is permanent. What is permanent differences? Government grant, I just told you. It means not today, not tomorrow, never. You don't need to pay tax on any of this. Never. Fines, if you get fine or penalties, no tax on it. No tax relief on fine. Political donation, no timing difference, is permanent, so no tax on relief on political. These two, no tax relief, no tax relief, but in this case no tax. But there are few in temporary, like dividend you will receive not today but tomorrow you will receive. It means you will pay income tax, you will pay tax, but not today, tomorrow. We have already studied warranty. It means that we will get the tax rebate or tax relief not today but tomorrow when we will pay this warranty. We have already discussed, we have already done the example. Next is inventory. I will explain next with the examples. There is anything related to the timing. I will tell you there are few more. Okay, let's do the inventory now. I need this space. I will write more, but I will explain inventory damage before I'll proceed. Okay, inventory damaged. What is that mean? Inventory damaged. Suppose the cost price was 1,000. Suppose the cost price was 1,000. For the storekeeper, they were bringing that mobile. Suppose he was bringing mobile and he dropped it. It got damaged. And then NRV becomes, suppose the NRV is 700 now. Instead of 1,000, now the net realizable value is 7,000 because of the damage. And we have studied a prudence concept. That if you see this, book the revenue, book the loss now, because inventory is recorded lower of cost or NRV, IAS 2. So accounting world says book your loss now. Tax department says no, you cannot book it now because it's unrealized. It when tomorrow you will sell it when you go for the market and you will sell it, then we will take, you can have the relief on this loss, on this damage. You can have a tax relief, but not today, because today this loss is unrealized, it's not being realized. But tomorrow when you will sell this and you will have a actual loss, then you will have a tax relief. Okay, this is the timing difference. It means not today, but tomorrow you can have a tax relief. It's being done, right? Next one is, where is it? Yeah, next one is IAS 38, intangible assets. What does it means? IAS 38. Let's see. IAS 38, capitalized development cost. Okay. When you book your revenue, when a company started start a project, and it says from, suppose the project start from January, and in March they are confirmed that yeah, this is going to happen, we have just found the cure for coronavirus. It means that medicine you can book as your asset, is become your asset, not the expense. But we have already studied all the research, or like we just put take them into profit and loss as an expense. We just expense out, but capitalized thing is being capitalized. So what you did is, as per today, you have your asset, and you going, suppose you have spent 100,000, you spend 100,000 on the cost, on the asset, and then after that it becomes your asset. It means asset. Then when you have finalized that this is a cure, and you gonna sell it, and then you can depreciate this, or amortized, you will start amortizing this asset in next years. You're going to spread this in a couple of years, so for the life of the asset. Okay, but the tax department, because you have already, because the account, as per the accounting world, we will spread this over 5 years. Suppose if it is for 5 years, if we have a patent, suppose if we have a copyright for Apple, then I would say that this phone, iPhone 11, no other market can produce, only me will produce, because I have the patent or the copyright for the 5 years. It means I will you can say I will amortize this cost for next 5 years. I will spread this in next 5 years. But tax department, because I have already spent it, so tax department will give me the relief today only. He would say, okay, you can have your full relief, full development cost relief today only. It is just the timing different, that is why it is a difference. Same as debentures. Next example, debenture or loan note issue cost. Suppose if we have 100,000 issue cost, and we have a debenture for 5 years, then as per accounting world, we will spread this expense for next 5 years. And tax department will give us tax relief today only, because we have incurred this expense, because they work on cash basis. You get my point, right? let's go. Types of temporary difference. What are the types? There are two differences. One is temporary taxable temporary difference, and one is deductible temporary difference. We have already studied this already, but I'm just giving you review. This will arise on future incomes. It means, but not today. In future you will receive this income, then you will have to pay tax on that income. It means dividend. We have already studied. So it means you will have a liability tax, deferred tax liability, where you did profit and loss and you credit deferred tax liability. It means this liability you will pay not today but tomorrow you will pay this. So this arise future income. Taxable TD means taxable temporary differences. Those differences which are taxable, you have to pay tax. It means future income. On future income you have to pay future tax. So there's a liability. It means it's not expense now, but it will going to be your expense soon. So what you did, you take a provision, you take a profit and loss and credit to deferred tax liability. And deductible, which means future taxable losses. Not the losses, best if I use future taxable profit decreases. It means whoever any expense, any loss which will reduce your profit, future profit, is a deductible or tax relief. I say tax relief, but is as per F7 book is this deductible temporary differences. Like warranty, it means not today but tomorrow it's you will have to pay warranty. It means not today but tomorrow you will pay warranty. I don't know how it's spelled. In this way, it means tax. Here you are having a liability, here you will have your asset. So we have studied as per the as per this, where is it, accounting standard T accounts, you can say. But today we will study SOFP account, which is SOFP approach, which is a 3-column approach. I will explain you. Carrying value, tax base as per tax department, and TD, temporary difference. This I'm going to write something, and then it is best if you take a picture, you save it. It's just the law, you have to memorize it. Asset, if it is a case of asset and you have carrying value is more than taxable base, then you will have a taxable TD. If carrying value is more than taxable base, then you will have your taxable. It means you have to pay tax on it. Temporary difference. If there is a liability, that in this liability, because of this liability, future profit will decrease. It means the carrying value is if the first let me write the liability on, you will get confused otherwise. Liability, sorry, need to write asset again. If एक बार उर्दू में बोलता हूँ, एसेट का केस होए और कैरिंग वैल्यू ज़्यादा होए, टैक्स बेस कम होए, तो यू विल हैव योर टैक्सेबल टीडी. और फिर एसेट का केस होए, कैरिंग वैल्यू कम होए, just reverse this. If it is a case of asset and the carrying value is less than taxable amount, tax base amount, it means you will have your deductible temporary difference. And these rules are reversed for liability. If carrying value is more than taxable base, then you will have deductible liability. And liability, if it is a case of liability and the carrying value is less than taxable base value, then you will have taxable TD. It is best if you just write it. Just take a picture. It is best if you take a picture, then I'll move. We have to study a lot today. I need to be very fast now. Sorry if I'm going fast. So for example 1, inventory. So I give you the same example. The cost was 1,000 and NRV because of the damage was 700. So the profit and loss, what you did, profit and loss 300 because you have a loss of 300 to inventory. This is as per the accounting world. This is what you do in accounting. Let's do in SOFP approach, 3-column approach. Carrying value, then you will have a tax base, and then you will have taxable temporary difference. It means carrying value is NRV is 700 as per accounting. The carrying value is as per accounting. As per accounting, the value is, previously the value was 1000. Because of this loss, it reduced to 700. So the carrying value is less than taxable base. Taxable as per tax department, it is still 1000. So we have studied here already. So if it is a case of tax asset, if it is a case of asset, carrying value is less than taxable value, tax base value, then you will have deductible temporary difference. It means you will have deductible temporary difference. And if you multiply this deductible, if you multiply this 300, which is this, if you take a difference of these two, you will have 300 difference. You will have this 300, and if you multiply this deductible temporary difference with the tax rate, and suppose we have a tax rate of 20%, it means this will be your deductible temporary, deferred tax asset is your asset because it's an expense. And here, as we have said it, if you are booking your revenue, then it is best if you book your expense, cost of sales, with the same period of time. So if you are booking your loss here, then you need to book your tax relief or your income, which is going to be 60. So tax deferred tax asset 60, because you will get 60 tomorrow, to profit and loss 60, because here is the profit and loss, here is profit and loss. So profit and loss is debiting, here credit is we are crediting to profit and loss 60. Let's do the second example, which is dividend, which I told you already. Dividend. Suppose we have received dividend receivable as per accounting, that we will receive 10,000. Maybe in future we will receive 10,000, and we did profit and loss, we credit profit and loss 10,000 as per accounting. Let's do the SOFP approach. Carrying value uh, carrying value, and then tax space. I need more space. Let's do it here. Carrying value, tax base, temporary difference. If it's a case of asset, if it is a case of asset, and carrying value is 10,000, as per my book it is showing 10,000. What, as per tax department, when I go to the tax department, they would say no, 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 we are not accepting it, because you have not received this amount today, you will receive it tomorrow, then we will we will take the tax tomorrow, not today. It means as per accounting book they have no value. So it means I will have a temporary difference of 10,000. Tax temporary difference, if you have a taxable temporary difference, multiply this with the tax rate, you will have your deductible tax liability. Because why liability? Because you will pay tax not today, but tomorrow you will pay tax. So if you booked your revenue here, and then you need to book your expense on profit and loss 3,000, it means 3,000 you have to pay profit and loss 3,000, and tax deferred tax liability 3,000. It means not today, but tomorrow you will pay this taxable profit, dividend profit. Let's do the warranty now. Same case, you said profit and loss, you take profit and loss and provision for warranty, you take provision for warranty. You said but not today, but tomorrow you will pay this expense, so you booked your expense, profit and loss. As per carrying, let's do this SOFP approach. Carrying value as per my books is 10,000. When I go to the tax department, they said tax base, they said no, we do not accept this, because you are not paying this expense now, you will pay this expense in future. So as per their books, it has no value, so 0. So temporary difference, I have 10,000. And if you have a temporary difference, taxable temporary difference multiplied by tax rate, you will have your asset. Because it's a case of expense, then you will have in future, you will have your tax relief. Tax relief means your income, your future income means your asset. So you need to book your deferred tax asset. How much? 2,000 here, and plus profit and loss 2,000. 10,000 is here, is also 2,000. Sorry, it's just 2,000 because I take 20% of these. Okay, let's do example now. Let's see. Plant price, life 8 years, residual value 40,000, 400,000. Straight line method. Depreciation. Tax expense. Tax expense or tax. I will tell you this new word, tax allowance. %40 on the year purchased. On the year purchased, and 20% on reducing balance. Tax rate 25%. Okay, take a picture of this, then I will move to the answer. It says, as per my books, how we will calculate depreciation. We have already studied cost minus residual value divided by life, 8 years. This means you will have 1600,000 divided by 8, so you will have 200,000 every day, every month, year. Okay, let's see, carrying value, and then we will have tax base, and this is temporary difference. As per my books, accounting books, cost is this, right? At year first x1, year first, year end first, year end first, I will say depreciated by 200,000. The carrying value is 1800,000. Okay, as per tax base, this was value, but they do not consider depreciation. They give you tax allowance. Whoever studied F6, they know this tax allowance, so they will have 40% tax relief. They will give us a tax allowance of 40% on the year of purchase. So they will have this. In this, how much the difference is for the first year, second year. Let's do the second year. Same, second year end x2, we have 200,000 here again. As per my accounting straight line method, we will have 1600,000 here. My NRV here, as per the text, it says 40% on the year purchase and then 20% on reducing balance. Take a 20% on this. Take a 20% on this, which is 240,000. So you will have 960,000. This is being the closing one, and the next year it will be opening balance. So what is the difference? If you take a difference of these two, 1600,000 minus 960,000, it means you will have 640,000 as taxable difference. Multiply this with the tax rate, you will have 160,000 deferred tax liability, because it's a liability you will have to pay in future. This is opening balance. Let's do the closing for the year 3. Same 200,000 from our accounting book. We will say After it says 1400,000, but as per account tax rate we will give 20% on this. So take a 20% of 960,000, you will have 192,000. It means you will have 768,000. If you take a difference of these two, like 1400 minus 768, it means this is the difference between tax and accounting world. You will have 632,000 temporary difference. If you take 25% tax rate, if you multiply this with the tax rate, you will have DTL, closing DTL of 158,000. This is closing. So what I did, now make a T account. Deferred tax account. Brought forward, brought down. Opening balance was, this was opening balance of year. This was a closing balance of 2000x2, but this year it was a opening balance. So opening balance was 160,000. And closing. Now the closing balance is how much. This was a closing balance. Now it means opening balance is being reduced, so it means you will have profit. Take it into profit and loss credit. It's not expense. It's not expense. So 2000 take into profit and loss. So what we can do is we can pass deferred tax liability hang on, it's debit and credit. It means it's a loss, then it's expense, profit and loss expense, the profit and loss and credit to profit and loss. So this is the way you can say so this is the way you can calculate. The last thing is I wanted to explain you is receivables, dividend done, deferred tax on revaluation, most important thing, deferred tax on revaluation, deferred tax on revaluation. Suppose I have a PPE cost 10,000. Suppose I have IAS as per IAS 16. I have 10,000 of plant and equipment. I got a building of 10,000, and after 1 year, this building market value for this building goes to 15,000. Suppose it has 15,000 profit and loss. It means what I did today, the market price is 10,000, but tomorrow the market price goes to 15,000. It means I will have a profit of 5,000 profit, or gain of 5,000, or revaluation reserve of 5,000. When I will go to the tax department, I said my property goes from 10,000, my property goes to 15,000. Here is your tax. The tax department would say this is unrealized profit. It's not actual profit. When you will sell it in profit, then we will take tax. So it means in future you will have to pay tax. So temporary taxable difference would be result in deferred tax liability, because in future you have to pay tax. Secondly, if you suppose you have a gain of 5,000, how we will write pp 5,000 debit, and what credit we will do, because in previously we were taking all the credit in profit and loss, but here it is a equity, so we cannot take this into profit and loss. This equity will go to revaluation reserve. Okay, and then we have already studied, if you are booking your revenue, then book your cost of sale along with this. So then you need to book your deferred tax liability. Suppose you have 5,000, suppose 10% on this, so suppose you have tax rate of 10%, tax rate is 10%, then 5,000 multiplied by 10,000, it means 500 is a deferred tax liability. So credit deferred tax liability, where you will take this liability, on which expense, profit and loss? No, here you booked it on revaluation, then take this expense to revaluation reserve. This was a tricky point. Previously we were using all the profit and loss, we were expensing it out, but this time around this is your equity. That is why we credit equity here and then we debit equity here. And as per SOFP carrying value, my carrying value was showing 5,000, but tax base said as per tax base they said we don't, this is your suppose carrying value is 10,000 here. So that's, if I say my 10,000 was my carrying value, as per tax department what they would say no, we do not accept this because unrealized profit. So that would be your 10,000 here. That's your liability. So this is the way you can calculate. This is the tricky point. If you're taking your deferred tax liability to profit and loss, then you can put profit and loss here, but in this case it was a matter of it's equity. That is why we are taking this into equity. And if you are having like in IFRS 9 we have studied financial assets and investments. So the fair value through OCI, there we studied there were two. One is fair value to through profit and loss, one is profit, and the second one is fair value through OCI. If you are using fair value as per OCI, then instead of revaluation, book deferred tax liability against OCI. Okay, and let's see. Next question. I will do the next question, but we will do just the equity part. We will not take any other part. Oh yeah, let me say one more thing. Carrying value, tax base, then you have tax temporary difference. Okay, if asset value, everything is there, asset, liability, everything. If you have taxable temporary difference, then you have deductible temporary difference, then you have taxable, and then again you have deductible. So the net amount you can take, so add them minus deduct this, add this minus this. Deductible has to be deducted and taxable needs to be added. Let's do one example with the revaluation reserve. Revaluation reserve. Let's see the net book value. The net book value, the property and plant equipment, that was 310,000. Let's see what example is it. 310,000. Tax written down value as per tax written down value as per tax value written down value is 235,000 as per 230,000 as per tax. This value, this has 230,000 value as per tax authorities. Tax rate 30%. Okay, so carrying value, then we will have tax base and temporary difference. Let's see. Carrying value in this case, as per carrying book net book value, as per accounting world, it is having 310,000, and tax base written value is 230. If you take a difference of these two, you will have, let me see, 310 minus 210, which means you will have 80,000 temporary difference. And if you take multiply this with the tax rate, which is 30% in this case, then you will have deferred tax liability. It means you will need to pay tax, but tomorrow how much you will have to pay? Take a 30% or 20, it will be 24,000. Okay, this is one bit. The second bit is, if you have a revaluation gain at end of the year, the plant equipment was 460,000. Suppose after 1 year PPE has value of 460,000 as per carrying value, and during the year revalued, okay, and revalued by 90,000, and by during 1 year it was being revalued to 90,000. How we will do in these circumstances? Okay, as per carry value, as per my carrying value, what it was showing, 460,000, and it says tax base value is 270,000, and you have a tax base value of 270,000. Written down value after second year is 270,000. Take a difference of these two, it means 190,000. You have a difference. Multiply this with the tax rate, which is 30% tax rate. You will have let's see, where is my calculator? Let's see. Yeah, 57. Okay. You can see 90, it was being revalued by 90,000. 90,000. What you did? Revaluation reserve to you must have credit 90 by 90,000, you must have credit 90,000, and revaluation credit, and you must have increased the PPE value by 90,000. You must have passed this entry. But tax base, they don't consider this revaluation because this is not a realized profit. 90,000 divided by, so the 90,000 you because they ignored this 90,000, but you still need to pay the tax liability. But in future, it means if you book because your deferred tax liability, it means in this, as per accounting value, it is being increased, but tax department, they do not consider this revaluation because it's unrealized, so they said there is no tax on this. So 90,000, if you say 90,000, put 30% of 90,000, it means you just have to pay 27,000 when you will sell this. You will sell in the next year, suppose. But today you have to book your liability by 27,000. And what you gonna do? You will not you will not expense this out on profit and loss because you have reserved. It was a equity part. Equity part is revaluation reserve. So take it into revaluation reserve. 27,000. See here, it is a cross. Opening balance was 27,000. Here your opening balance is from the previous year closing is 24,000. If I make a deferred tax T account, brought down 24,000. Where is it? Suppose 24,000. Yeah, 24,000 previously, and this year closing balance was. This year the closing balance was. Let's see where is written. $57,000 closing balance. This is your closing balance. So previously what you did, you just do the difference between these opening and closing. This will be your current for the year. That will be your current. But this time around, because out of this 24,020, where is it? Out of this was being raised because of the revaluation reserve. So take this in account, revaluation reserve, which is 27,000, and then the balance you will go to here. The balance you can take here, 15,000. So that was a tricky part because previously what we did, 24,000 opening minus closing, which is 57,000. The rest we take into the profit and loss. But this time around, out of this balance is coming because of the devaluation reserve. We need to pay tax on devaluation reserve, but not today, but tomorrow we will pay. I know I've been very fast, but it is best because I need to record the same lecture in Urdu as well. So it is best if you pause my videos and watch my channel. Watch this video over again. Okay, I will make more videos. If you can give me the comment which video you want me to make, what IAS, which standard you want me to make a video on, and then I will make more videos. Otherwise I will say, let's see which there are a lot to do more. So I will maybe IAS 20 government grants. I will make a next video on IAS 20. Today we have completed IAS 12. And I will tell you I have already told you opening minus, if you have opening minus closing provision, whatever it takes, the balance goes to profit and loss, and then add or less under or over provision, and then we will pay tax. I will tell you when in the final account. You when deferred tax plus current tax in final account. This is what we do in final account. So what you do, this is the last topic. Estimated current tax liability. This is current one. Add, if you have under provision, need to add. If you have over provision, less over provision from previous year, minus. Add deferred tax charged, or less if you have tax rebate, deferred tax credit or rebate. If you have a tax rebate, minus. This would be your profit and loss. This will go to profit and loss. This is the main bit. So let's do one last example. Income tax payable, 60,000. Over provision, 4,500. Opening deferred tax provision, profit is there. Closing deferred tax provision, 3,200. Okay, this is your question from your exam kit. Tasmin, question name is Tasmin Company. Oh, okay, it's Tamsin. Sorry, it's Tamsin Company. Okay, what you do is first take difference of these two. Opening minus closing. First do this. Opening is 26 minus 3,200. It means you will have 6,600 difference. So closing is more, 6,000. Okay, so we have studied already. So this is deferred tax charge, then we need to add it. It means instead of this year provision, instead of 2,600, we need to pay 3,200. It means we need to pay 600 more. So current tax. How much was this tax? Current tax was this 60,000 was current tax. Okay, 60,000 was current tax, less because over provision is written here, over provision. So over provision is need to less. So it was being over provision for last year. How much was over provision? 4,500 was over provision. So minus 4,500 over provision. If you minus 4,500 and then add, because you have to pay 600 more, add deferred tax. This is a deferred tax, so you need to pay 600 more. So balance would be 56100. That will be your balance. Let's do last question, which with the revaluation reserve. Tax 7,000 in the credit side of trial balance. Deferred tax also 16,000. This is also from the question kit, exam kit. 16,000 credit side. It is, if it is credit side, it means it is not expense. This tax, if you find current tax or taxation on credit side, it means over provision. It is over provision. And if you see on the debit side, it means it's an expense, then it will be your under provision. Deferred tax is also credit. And estimated provision for this current tax provision is 12,000. Okay, we have a current tax provision is 12,000, and deferred tax needs to be increased to 23,000. The balance on the deferred tax needs to be increased to 23,000, and it includes the deferred tax needs to increase to 23,000, and it includes revaluation reserve. During the year, gain of 10,000 pp, tax rate 30%. Okay, what amount will go to profit and loss? So it says, I'll tell you the example, the whole scenario. When you see the final account in your exam, see this tax thing, is it on the credit side? If it is on credit side, it means it's not expense, it means it's over provision from last year. And if you see this, if you find this in your debit side of your trial balance on final account, it means it's an expense, it's under provision. Current tax, company keeps a provision for this tax year to pay in the next year. So if I pay my company, if I wanted to pay 5,000 next year, I know I have to pay 5,000, then I will create a provision account and I keep 5,000 in reserve. So it needs to be increased to 23,000. The question says this has to be increased to 23,000, and it includes the revaluation reserve, and revaluation gain is 10,000, and the 30% is your rate. How we will do this question? First is take a picture and then I'll move. Okay, current tax. What is a current tax provision? Current tax provision was 12,000. This is your current tax provision, because you have to bring deferred tax and current tax together to fix this problem, to fix this temporary difference. Then if it is over provision, then you need to minus it, because we have already studied, if you're under provision, add over provision minus over provision was 7,000. And now is the tax, deferred tax. How we will calculate deferred tax? We will calculate deferred tax. Okay, opening and closing. What was the opening? Opening was okay, there's the tricky part. 23,000 minus 12,000. 23,000, because it says it has to increase to 23,000. It means this will be your closing balance. I need more space in this area. So the closing balance will be 23,000. Okay, and deferred tax, opening deferred tax is 16,000. Opening deferred tax is 16,000. But do not take opening and closing difference together, because we have a gain of 10,000 and we need to pay 30% on this gain. So revaluation gain, we need to pay 30% on this. It means out of this 3,000 is because of the revaluation gain. Revaluation reserve, this will go to revaluation reserve, and then the balance, take a balance, and then the balance will go to profit and loss, which is 4,000. This is your expense. If it is coming on this side, it means it's an income, but if it is coming on this side, it's an expense. So take this amount to profit and loss, which is 4,000, and then how much you need to pay? 9,000 will be your profit and loss. This will go to your profit and loss statement. This is the way you calculate. This is the end of session now. So if you have any question, you may ask. All right, see ya, bye.